Good evening, everyone. It is Tuesday, December 17th. This is a special report that I'm going to do. This is the eve before the Fed meeting in the U.S. tomorrow, where seems to be a certainty of a 25 basis interest rate cut. And then more important is going to be the guidance and the discussion that will come post that announcement. And we are in a fascinating market in the U.S. indices, one that I have not experienced in my 40 years of trading on a number of different levels. I can make a bullish case, a very bullish case. I can make a very bearish case. I want to emphasize, I'm not going to make some dramatic call here. I don't really know what's going on. I'm an interested observer. I think there's going to be a lot of opportunity coming up very, very soon. Whether it begins tomorrow, I don't know, but certainly by the you know beginning of the year, there will be more clarity than we have now. Let's take a look at some of the charts and some of the things that I want to share with you and discuss tonight. Uh, so here are the four primary U.S. trading indices: SPX, NDX, Russell, and the Dow. These are weekly charts. I'm going to go down to a daily view. And what I want to point out, there's several things, but let me make the bearish case first. At almost every single significant pivot high of an intermediate term or larger degree, you have what we have now, which is a very significant divergence and disparity in the structure and the level of the four primary U.S. trading indices. We have had the index that has just gone straight up. It's up almost, I think it's up almost 9% off this mid-November low. Let's see, almost, not quite. Let's call it 9% rounded up. And then, it's spent the last couple of weeks going straight up as the others have either gone straight down, which is the case in the Dow. The Dow has closed down 9 consecutive days. That has not happened in my trading lifetime. I've been trading 40 years. I'm 99% sure this is unique. And then, of course, you have the Russell. It's also now it's had some up closes in that period, but it's been pretty much straight down as well. Also, the New York Composite. The New York Composite is extremely weak. Breadth is extremely weak, which brings me to a potentially bullish scenario. Let's take a look at breadth. Okay, now what you see here, this is a simple view of breadth that I've kept for most of my trading career. I don't use indicators, oscillators, magic numbers. I use only market generated information. This is market generated information. The red line is a 10-day moving average of NYSE advancing issues. The green is a 5-day moving average of advancing issues. And the blue histogram is closing breadth. Now, this is sort of a blunt instrument. It can be a very good guide at times. It cannot be road traded. It tends to have very specific characteristics in bull markets and bear markets. And if we are in a bull market, we could be near a very significant pivot low time wise. Now, I want to show you another instance over here that seems somewhat analogous, that's fairly recent to where we are now. So, this is a balance area, right? You guys know what a balance area is? It's a consolidation. If we were to pull up a market profile chart, this would be that nice Gaussian shape that everybody associates with market profile right here. Okay. Now I want to show you another instance. Now I want you to notice where the 10-day moving average of NYSE advancing issues is. That it is on the cusp of being extreme to the downside. I typically do not use the terms or encourage use of terms overbought, oversold, because there's really no such thing. But this is getting to the point where it is at the upper cusp of extreme, and from where you, in bull trends, you start to look for lows and potentially significant rallies. It happened here. I can go back, you guys that have been with me a while, you know this. Now, there's an interesting analogous situation to where we are now. We have this balance area, and the 10-day moving average has worked itself down to, has contracted to a pretty extreme level to the downside. So you might be looking for a low here. Now, I'm going to show you another situation over here, okay? This was another situation where you had the market get down to an extreme right here, but you had this balance that occurred right in this area here. And there was a ledge right here. Well, we have a ledge, the low extreme of this balance area right here. Now, if you notice, time-wise, we were close to a low. Price-wise, we got hammered a little bit from this level. Price-wise, we went down about 4%. Now, that's no great shakes, but it was ultimately about a 6% decline. Well, a 6% decline, just for fun, we'll see, would carry us down. People would be freaking out if we went down 6%, but that's a pretty mild decline. But the point of this is that we're if it would be ideal in my mind if we got a big flush here to the downside that lasted 2 or 3 days and carry this thing into the 5 or 6% downside level. Now, right here, this is a very important level. And then below this level is important. So that would potentially take us through this level to this next level here. What are these levels? These levels are market-based levels. These are levels that the market found lows. The market tested these levels on several days here and rallied. It tested this level again several weeks later on several different days, rallied, etc. So I don't know where this level falls in the magic number game, but if you put a fib retracement from here to here, it's probably, I'm eyeballing, I don't know, maybe 50% for what that's worth, but that's coincident. It's not causative. So this is the potentially bullish case from this perspective. Now, again, that bearish perspective suggests that, okay, we had this massive divergence between the NDX and all the other indices, including the New York Composite. Breadth has been, you can see breadth is as low as it's been since last spring. But again, we have 7 stocks that have been driving the NDX. It's also, to add confusion to this is a seasonally positive time, typically a seasonally positive time of year. However, there's still room for this market to crater into, for 2 or 3 days or 4 days into next week, maybe. And then after Christmas or right before Christmas, the market begins this face-ripping rally back to the upside. What do I think is going to happen? I genuinely do not know here. Again, I'm a trader. I don't make a living predicting markets, but I do think there's going to be tremendous opportunity in here. And what I would advise is know your time frame. If you are a super short-term trader, whether you're trading intraday or you're trading 2 or 3 days, I would not be fading conviction in here. So if you see the market cratering, you want to go with it. You don't want to be catching the falling knife. If you see the market screaming higher, you want to go with it. But then on a little bit more farther out time frame, a little bit larger degree time frame, if we do crater in here, frankly, I'm going to be, at least initially, looking for a low of potential significance, and then potentially a rally into the end of the year. Now, again, this is a special update. I do these updates every weekend. So this weekend, on the update that I'll send out on Sunday evening, we can revisit all of this. You guys have a good evening, and I'll speak with you again soon.